This is everything gold investors must know before the next rally. As we know, gold and silver are in very severe corrections right now. They're getting very oversold, and there's definitely growing risk of final capitulation in the coming days and weeks to this correction. But in this video, I want to step back from the technicals and discuss fundamentals because I want you to understand what to keep in mind, what to look for over the coming months before that really next big move in the sector begins. I'm Jordan Royburn, a chartered market technician, a master of financial technical analysis. Thank you for joining me for this fundamental look at gold and what's driving the market right now. Okay, so let's start off here with gold and its macro fundamentals. Here's gold. Here is their real 10-year yield right here. Here's the yield curve. Here's the nominal 10-year yield and the nominal 2-year yield. Okay, nominal 2-year yield, this is what the Fed follows. So this is a good proxy for Fed policy and short-term interest rates. The yield curve, as I've said in past videos, a steepening curve, and that's the spread between the 10 and the 2-year. A steepening curve, so when the spread is getting bigger, when it's widening, when it's increasing like this, that's bullish for gold. When it's narrowing like this, that's bearish for gold, which means the spread between the 2-year and the 10-year is narrowing. So that's negative for gold. Now, what's also negative is that real interest rates here, as we can see from the real 10-year yield, that's what this data is, have been going up like that. So real interest rates are rising, not good for gold. Yield curve flattening, spread is narrowing, not good for gold. Okay. So to make it really simple for gold, what gold really needs is a 10-year yield to be increasing faster than the 2-year, or you need the 2-year yield to be going down. It's going down faster than the 10 years going down. That means the Fed is cutting. Fed is easing. But when the spread is narrowing and this is rising faster than this, that's usually when the Fed is hiking. So the market is telling the Fed it should start hiking. Now, eventually, what would be bullish for gold is if we see some upside pressure on the 10-year yield and 30-year yield as well. In the last couple months, as you can see here with respect to the 10-year yield, it hasn't broken out yet the way this has. So this is a positive divergence to the 10-year yield. Now, last thing here I want to mention, I do want to get back to in the 70s, what I think we're eventually going to see, maybe after the next year, 18 or 24 months or so, is when you see longer-term interest rates are rising. Like when you see longer-term interest rates rising, you can have the curve steepening, even if this is flat or rising a little bit. And so that's what happened in the 70s, where, to repeat myself, long-term interest rates and yields were rising, okay, because inflation expectations were rising. So again, it's not imminent, but in the next, maybe 18 or 24 months or so, when you start to see upside pressure with respect to the 10-year yield, the Fed is going to have to come in because of the debt situation and do yield curve control and basically start buying long-term treasuries to keep these interest rates from going through the roof. But again, this is not something that's going to happen in the next 3, 6, 9, or probably even 12 months. So it's not bullish yet. Okay, now getting to my next chart here. So this is keeping things a bit more simple. We're putting aside long-term interest rates. We're focusing on Fed interest rates here, short-term rates, and then the 2-year yield here. So 2-year yield here. This is Fed funds rate here. And you can see how similar they look because I mentioned this is a proxy for this. And really the Fed follows the market. And so here and now, we've seen this move in the 2-year yield, but the Fed is stuck like this. So the market is telling the Fed, you need to hike. Now, we know that the president doesn't really want the Fed to hike, but the market may force its hand. So it may force the Fed to hike a couple times anyway. Now, one hike is probably already being discounted by the gold market, because gold is almost down 30%. Okay, that's a significant correction in a secular bull market. So the market has already discounted probably one hike, maybe not two, but I'd say one hike. And so even if the Fed hikes once or twice, they could get this over 4%, and that would give them room to cut when the economy softens and when inflation readings soften. And they have the political cover to do that because you can't cut rates when gold is near 6,000. But gold down here at 4,000, this gives them the political cover to cut rates. But again, they might have to hike a couple times before they start cutting. Now, to the important stuff. That does sound bad and negative that the Fed might hike once or twice, but let's review some history. Now, these red lines mark the last 3 times that the Fed started raising interest rates. And you can see here, December 2015, I think this was also December 2016, they did a hike here, but then they basically paused for a year before doing the next hike. So you could say there was actually 2 starts to this hiking cycle here, right here. So the Fed starts hiking here, and gold actually bottomed right here and here when they started the hiking cycle. So the market had already discounted the hike to come. Now, it was different in 2022 at the start of this cycle because gold, you had the Russian invasion, and gold popped up nearly to its all-time high, and the Fed hadn't hiked yet. So the Fed started hiking, gold went down 20% before making this bottom. So when the Fed started hiking here, the market had not discounted that yet, but it discounted it here and here. And you can actually go back and look from 1999 to 2004, and gold had similar bottoms where when it started hiking, it started a new hiking cycle, gold had already bottomed because it declined into the start of the hiking cycle. So what does that mean for here and now? Gold has already discounted probably 1 rate hike here. And so if the Fed does a hike or 2, that could mark a significant bottom in the market. So it's not a bearish development because the market has already discounted that. Now, these 2 lines here and here, this marks when the 2-year yield peaked. So very interesting. Peak in the 2-year yield here, down here, and gold actually bottomed here 3 months before the 2-year yield peaked. Now, you have this bottom here in gold, October 2022, when the 2-year yield was here or a little bit higher. So the 2-year yield kept going higher like this, yet gold had already bottomed here, ahead of the peak in the 2-year yield. Now, the peak in the 2-year yield was here, and that was at the end of 23, a couple months before the epic breakout in gold, the cup and handle breakout. So how does this pertain to now? Well, we know that this move in the 2-year yield is not going to rise forever. So at some point, this is going to peak. There's a lot of resistance at 5%. It's already at 4.2. And if you tell me this peaks at 5%, the worst could be over for gold when it hits 4.6 or 4.7% or 4.5%. So to sum it all up, unless we see long-term yields really start to move to the upside and blow out to the upside, which would help gold, the key thing to watch will be the 2-year yield for its peak. And so in the very short term, we're looking for gold to make a capitulation low here in the next couple weeks. And then we'll keep an eye on the 2-year yield at the same time, because this could tell us how much longer the fundamentals for gold in the short term could be perceived as negative. Because as this moves up and the closer it gets to 5%, all the negative fundamentals are being discounted. And by the way, if we see gold plunge here to 37 or 3,800, perhaps that has already discounted the move to 5, and then you see gold make a bottom like it did here or even here before the 2-year yield peaks. So I know this macro fundamental analysis can be boring, but I appreciate you sticking through the video. Thank you, and I'll talk to you guys on Friday in the Friday Weekly Market Recap.